This is Dr. Farhat Iqbal from Polar Design Studio with a brief overview on why carbon accounting is important for your company to address global warming. Our Earth's ecological crisis is approaching a tipping point. Without urgent action, climate change poses an existential threat for civilization. The year 2020 was 1.2 degrees Celsius warmer than the average year in the 19th century. Global warming has brought us closer than ever to the 1.5 degrees Celsius warming threshold, beyond which scientists warn of extreme catastrophic climate change events. Global temperature differences between 1981 to 2010 and now across the Earth have increased. For example, Siberia, which accounts for 9% of the Earth's surface formed of permafrost, temperatures there have increased 3 to 7 degrees Celsius. With higher temperatures, melting permafrost can add billions of tons of carbon dioxide equivalent to the 600 billion tons already present in our atmosphere. This could rapidly take us beyond the tipping point and should be avoided at all costs. The growing threat of intense wildfires, melting glaciers, floods, droughts, water scarcity, and food insecurity is wreaking havoc on the environment and our well-being. To keep our planet's temperature aligned with the Paris Accord at 1.5 degrees Celsius to 2 degrees Celsius rise, we need to reduce global greenhouse gas emissions by 3.2% each year between now and 2030. This will keep us on track to net zero carbon. Anthropogenic greenhouse gas emissions from fossil fuels and land use exceed our Earth's absorption capacity by land and ocean sinks, resulting in 18.7 billion tons of carbon dioxide equivalent built up in the atmosphere every year. The accumulation of unabsorbed greenhouse gas emissions is heating up our planet with a devastating impact on the climate. Unless countries and businesses take action to reduce, measure, and report their emissions and pledge to net zero carbon, we cannot limit the temperature rise to the 1.5 degrees Celsius goal by the end of this century. We are currently not on track with limiting the Earth's temperature to 1.5 degrees Celsius or 2 degrees Celsius pathways. The current trajectory will increase the Earth's temperature 4 to 6 degrees Celsius by the end of this century. Countries, businesses, and entities need to pledge emission cuts to their respective carbon emissions on science-based targets to net zero carbon by 2050. Although some 120 countries have pledged to achieve a net zero carbon target, the pledges are not backed by adequate action. Recently, the US and Canadian governments have committed to become carbon neutral by 2050. This means committing to science-based targets, bringing in regulations to decarbonize businesses, public assets, and external supply chains. Realizing the country's serious commitments on climate change, significant carbon-emitting entities should speed up to set science-based targets for emission reductions aligned to the country's carbon-neutral goals by 2050. Climate change is like a cancer. The more you wait, the larger it will grow. By continuing to invest in carbon-intensive infrastructures, the material risk of stranded fossil fuel assets grows. In delaying action, global negative emission requirements will become higher and impossible to achieve. Remaining indifferent to the climate change risk will cost us more through catastrophic events. Lassitude now means an opportunity lost, irreversible damage to ecosystems, water shortages, food crisis, mass migrations, and conflicts. Before committing to science-based targets carbon neutral goals, businesses and entities need to establish their baseline carbon footprint of greenhouse gas Scope 1, 2, and 3 emissions. Scope 1 are direct emissions from operations within the facility, including on-site fossil fuel combustion. Scope 2 are indirect emissions from purchasing steam, heating, cooling, and electricity generated by fossil fuel-powered plants. Scope 3 emissions are the supply value chain greenhouse gas emissions. These are the upstream and downstream value chain emissions from procured products, transport of suppliers, and business travel. Most businesses and entities report Scope 1 and 2 emissions to regulatory bodies, EPA and Environment Canada, for facilities exceeding 25,000 tons of carbon dioxide equivalent emissions threshold per year. Some businesses also voluntarily disclose through the Carbon Disclosure Project. However, very few businesses have their greenhouse gas Scope 3 accounted. More businesses need to measure their products' value chain Scope 3 emissions to set a baseline for science-based targets emission reduction goals. Scope 3 generally account for 70 to 80% of the product's emissions. Not including Scope 3 will leave the company out of options to find risks and opportunities for emission reduction goals. By accounting for Scope 3 emissions, businesses can identify greenhouse gas intensive materials and activities which pose a risk under the growing climate change constraint. They can influence their suppliers to reduce the greenhouse gas intensity of their materials or activities. Businesses can explore opportunities to reformulate their products, modify or innovate manufacturing processes to eliminate high carbon intensity value chain materials. They can include greenhouse gas reductions by their value chain for their carbon neutral goals by 2050. There are many advantages to compiling Scope 3 emissions from your product. To measure the value chain's greenhouse gas Scope 3 emissions requires a thorough understanding of the different stages of a product's life cycle evolution from cradle to grave. Materials may be derived from different sources like extraction from the earth, agriculture, or a manufacturing process of material formulation into a product and thereafter the product use and ultimate disposal. Generally, multiple entities are involved in the evolution of a product from start to finish. An example of a product's cradle to gate life cycle is a raw product from mining, drilling, or agriculture delivered for further processing. The example of the gate-to-gate stage is a product received by another entity for further processing, such as iron ore processed to steel, crude oil refined to fossil fuel, and coffee beans processed to brand products. A product may go through multiple gate-to-gate stages. The gate-to-customer example is the car, the gasoline at the pump, and the coffee brand we enjoy. The gate-to-grave of a product's life cycle is the final disposal at the junkyard or the landfill. An entity's upstream life cycle emissions are considered their cradle to gate, and the downstream gate-to-grave emissions are from the transport of a finished product, use, and disposal for purposes of regulation, research and development, and stakeholder concerns. To make a more sustainable product, a complete life cycle inventory is important. Polar Design Studio can help in establishing a cradle-to-grave life cycle sustainable model system for our clients. We will calculate the Scope 1 and 2 emissions and estimate the cradle-to-gate and gate-to-gate Scope 3 upstream and downstream emissions for the baseline determination and a carbon neutral strategy. We will establish a baseline life cycle inventory for Scope 1, 2, and 3 emissions using process flow diagrams and generic emission factors from extensive databases such as EcoInvent, US EPA, EU, and Gavi. Spreadsheets-based data can be refined further for building the client's life cycle inventory using actual data of the facilities and the supplier's facilities. This approach provides the life cycle inventory footprint in real time on actual data of our clients for their carbon reduction, sustainability strategies, and financial modeling. Maintaining a spreadsheets-based Scope 1, 2, and 3 greenhouse gas emissions inventory is cumbersome, especially if a company owns numerous facilities across different locations. It's highly valuable to develop the company's greenhouse gas information management system on a robust, flexible, and reliable software-as-a-service platform to alleviate the burden of collecting and compiling greenhouse gas data each year on hundreds of Excel spreadsheets, difficult to maintain and can break. With the Greenhouse Gas Information Management System, data is entered and automatically loaded at different facilities and locations. The Internet-based Greenhouse Gas Information Management System accurately compiles and tracks all greenhouse gas emissions data from respective facilities to the corporate level centrally to generate customized reports in regulatory formats. The reports can conform to different protocols such as the Canadian Federal and Provincial Reporting, US EPA, EGRIT, TCR, CDP, and more. These reports can be used for greenhouse gas reporting, corporate risk and opportunities assessment, greenhouse gas tracking for carbon offset projects, carbon credits, and greenhouse gas reduction planning. We can configure a complete greenhouse gas accounting system and carbon accounting strategy on the Greenhouse Gas Information Management System for our clients. In our upcoming videos, we'll guide you through our step-by-step approach on how to perform your business or entity's carbon accounting for developing a carbon neutral 2050 roadmap.